23.69% annualized trailing total return from a dividend fund, plus higher cash distribution yields than VOO. Is this newcomer dividend fund a secret weapon for income-seeking investors? Hello everyone, and welcome back to Markets with Marcus and what is already part 5 of our Dividend Fund Miniseries. In the first 4 parts of our Dividend Fund Miniseries, we covered SCHD, Schwab's US Dividend Equity ETF, VYM, Vanguard's High Dividend Yield ETF, and VIG, Vanguard's Dividend Appreciation ETF, as well as FDVV, Fidelity's High Dividend ETF, all linked below for your convenience. Today, we are going to speak about an interesting dividend fund that one of our members brought up recently in our VIP investment club, Capital Group's Dividend Value ETF, ticker CGDV. CGDV has outperformed S&P 500 ETFs like VOO with an annualized 23.69% trailing total return over the past 3 years, and it also shows higher cash distribution yields. You could almost call it a secret weapon for potential growth. But as our Diamond NestEgg members and regulars know, you can never have it all in finance. And the open question is whether CGDV would really be a good fit for income-seeking investors. So with that in mind, here are the 3 topics that we'll be covering today. 1. How does CGDV select its stocks? And what names does it currently own in its portfolio? In this section, we'll also discuss that CGDV is one of the rare actively managed dividend funds and what the potential implications are for investors. 2. What is the track record of CGDV? Ever since Jack Bogle launched the first low-cost index fund for the wider public in 1976, active management has become a bit of a red flag for many retail investors. So in this section, we'll explore how CGDV's active management worked out for shareholders in the past in terms of net performance after all costs have been deducted. And 3. Who might want to consider buying CGDV? In this section, we'll also discuss whether we would personally buy CGDV. Not necessarily for the base part of our portfolio, which should provide us with a stable, lifelong income and help us sleep well at night through all the ups and downs of the market, but maybe for the boost part of our portfolio that might give us more potential long-term growth, but also more short-term volatility. Please remember that all numbers in this video are for illustration purposes only, and as of the time of this taping on July 2nd, 2026, and that past performance is not indicative of future returns or outcomes. Let's get started. How does CGDV select its stocks? And what names does it currently own in its portfolio? Capital Group's Dividend Value ETF, ticker CGDV, has 36.3 billion in total assets at the time of this taping, which puts it squarely in the top 5 of dividend funds. So maybe it's not that much of a really secret weapon for potential growth after all. It is actively managed, as I already mentioned, and as far as we can tell, it's the only actively managed dividend fund not just in the top 5, but also in the top 10. So let's take a look at what this might mean in real life. To start with, CGDV's goal is overall quite similar to most other dividend funds: to balance above average income with growth. Or, as they formulate it themselves, the fund's investment objectives are to produce income exceeding the average yield on US stocks generally and to provide an opportunity for growth of principal consistent with sound common stock investing. To do so, CGDV's management does have a quite open and flexible mandate, it seems. We could only see 2 main constraints in the fund literature. One soft constraint is that it invests primarily in dividend-paying stocks of larger, established US companies. And one hard constraint is that up to 10% of assets, but not more, may be invested in stocks of larger companies outside the United States. A wide mandate like this one can be a double-edged sword for investors. On the one hand, it opens up opportunities for the fund managers that index funds just wouldn't be able to seize. On the other hand, though, it makes it even more difficult for investors to anticipate how their investments may behave under different market conditions. So that's something you need to be comfortable with before you buy shares of CGDV. In addition, active management generally comes at a cost. And indeed, CGDV's expense ratio of 33 basis points is noticeably higher than for all the other funds that we've been discussing in this Dividend Fund Miniseries so far. Although, I would add, 33 basis points doesn't sound completely unreasonable either in the grand scheme of things. CGDV was launched a bit more than 4 years ago on February 22, 2022, and like most dividend funds, it pays dividends 4 times per year. Its last share price was $48.95. Now, let's look at how the fund managers have used their flexibility. CGDV had a total of 52 equity holdings and 4 cash positions at the end of May 2025, giving it a very concentrated portfolio. For comparison, Schwab's SCHD had about 100 positions, and Vanguard's VYM had even more than 600. CGDV's top 10 names include an interesting mix of industries. On the one hand, we have 6 tech companies. 5 well-known ones like Nvidia, Microsoft, Broadcom, Meta, and Alphabet, but also one maybe less prominent name with Applied Materials, which sells the manufacturing equipment, software, and services needed to produce semiconductor chips and advanced displays. Then we have 3 more old-school industrial companies: General Electric, RTX Corp, the aerospace and defense company formerly known as Raytheon, and air conditioning manufacturer Carrier Corp. And to round out the top 10, we have Royal Caribbean and its cruise ships. I would guess that this mix would be hard to replicate for an index fund. In any case, in the big picture, we can see that CGDV's portfolio is dominated by information technology at 34.4%, which is not much less than the weight of information technology in the S&P 500 at 38.6% at the same point in time. The next largest segment is industrials, which account for 13% of CGDV, 1.5 times as much as the 8.3% weight in the S&P 500. As for the international exposure, 7% of CGDV's portfolio is in non-US equities. Let's move on now to the next section and see what this all would have meant in terms of returns for investors. What is the track record of CGDV? As I touched upon earlier, actively managed funds like CGDV are generally more expensive than index funds. However, this is not really relevant for the performance track record that we are going to discuss in this part of today's video. All the numbers that we'll be showing you shortly are already after cost, meaning you don't need to deduct the expenses again. So let's begin with CGDV's dividend history, which is relatively short given its young age. In its first full year, 2023, CGDV paid a dividend of 49.32 cents per share. This went up to 56.49 cents per share for 2025, and you can see that the bars look pretty stable. However, if we annualize the 2 dividend payments that we already have for 2026, we get to only 51.48 cents per share, which would be a small dip. But of course, the second half of 2026 may turn out completely differently for CGDV than the first half. Let's see what the historical performance of CGDV looks like now. The dividend numbers that we just discussed translate into a 30-day SEC yield of 1.32% and a TTM yield, a trailing 12 months distribution yield per Morningstar, of 1.19%. Both distribution yields measure annualized cash distributions, divided by the share price at the end of the last observation period. The only difference is that the 30-day SEC yield, as the name implies, takes the payouts, essentially the dividends, from the last 30 days and annualizes them, while the TTM yield uses the actual distributions over the past 12 months. And here we can see that 100% of CGDV's dividends were classified as qualified dividends for taxation purposes in 2025, which might be relevant for tax-sensitive investors. For investments held in a normal taxable brokerage account, qualified dividends may be taxed at the usually lower long-term capital gains tax rates and not at the full marginal income tax rates that apply to both non-qualified dividends and interest payments. As customary, please keep in mind that we are not tax advisors at Diamond NestEgg. Always consult with your trusted tax advisor for your specific situation. But distribution yields are only one side of the story. Remember, CGDV is still an equity fund at its core and aims to deliver both income from the dividends and growth from the potential appreciation in the stock prices of the underlying portfolio. On the flip side, of course, shareholders remain exposed to the downside risk of all the stocks in the portfolio, and dividends are never guaranteed. So let's have a look at CGDV's trailing total returns. The trailing total return tracks what an investor would have made from both dividends and capital gains or losses. So, had an investor bought CGDV 1 year ago, his or her total return would have been 23.44%. Had an investor bought CGDV 3 years ago, the trailing total return would have been 23.69% on an annualized basis. Now, CGDV's track record isn't very long yet, but these are very respectable returns, not just for a dividend fund, but for any growth-oriented equity fund as well. In fact, over both the past year and the past 3 years, CGDV's trailing total returns from both share price gains and dividends here were about 3 percentage points higher than those for Vanguard's S&P 500 ETF VOO of 20.47% and 20.41% respectively. And if we look at the entire time since its inception in February 2022, this chart shows that CGDV, the blue line, has shown noticeably higher total returns than an S&P 500 fund like VOO, the dark red line, at plus 108.38% in total for CGDV versus only 81.87% for VOO. So this may be an example where active management was working for investors, at least for the past 4 years, but who knows what the future might look like. Plus, as I mentioned already, you can't have it all in finance, and in particular, you can't have both top income and top growth. So the flip side to the frankly impressive historical total returns of CGDV is that its dividend yields, its cash distributions, were not impressive. Yes, both CGDV's 30-day SEC yield of 1.32% and its TTM distribution yield of 1.19% were higher than VOO's 1.03% and 1.07% respectively. But that's VOO. Compared to the other dividend funds that we've discussed in this mini-series, SCHT, VYM, VIG, and FDVV, CGDV has the lowest cash distribution yields of all. So, what are your thoughts on CGDV at this point? Do you like its track record of delivering strong total returns that were even ahead of an S&P 500 index fund like VOO, and care less about its income potential relative to the other dividend funds that we've already covered? Or would you rather lock in a higher guaranteed income for life with annuities? Or perhaps treasuries and other top-rated bonds? Drop a comment below and let me, Jen, and everyone else know. Or come on over and join our VIP investment club, where these conversations are happening every day amongst our safety-oriented but nonetheless yield-seeking members. And let's move on now to the next part of today's discussion. Who might want to consider buying CGDV? As I've said before in our Dividend Fund Miniseries, we personally don't own CGDV nor any other dividend funds currently, as we are still very much in the growth phase, with a sufficiently long time horizon that should allow us to ride out any volatility and setbacks in our S&P 500 funds and similar investments. And if it comes to guaranteed income, we generally prefer annuities, treasuries, and similarly safe bonds. Remember that the base part of a portfolio should mainly be oriented towards safe, stable, and predictable income that lasts a lifetime. And neither CGDV nor any other dividend fund is built for that. But that's us at our current stage in life. When the time comes for us to retire, we could see ourselves revisiting CGDV under a different lens. And for us, personally, we would probably look less at CGDV's income potential and more at its strong track record for trailing total returns. We could see a place for CGDV in the boost part of a portfolio if you can agree with the following statements. 1. You want to be in the market for the potential growth and are not afraid of a possible AI bubble or general market downturn. In this case, and knowing that past performance is not indicative of future results or outcomes, CGDV's historical track record of delivering stronger trailing total returns than an S&P 500 fund like VOO might be a good reason to take a closer look at it as a potential secret or not so secret weapon for potential growth. 2. You have already covered the base part of your portfolio, the part that can provide you with a guaranteed lifelong income, with annuities, treasuries, and similarly safe fixed income investments. If that's the case, you might not care that CGDV's distribution yields are low, even for a dividend fund, and you might be in a position to take controlled risks in the boost part of your portfolio. Remember, neither your principal nor the dividends are guaranteed with CGDV or any other dividend fund. 3. You can get yourself comfortable with the wide flexibility and discretion that CGDV's managers have under its active mandate, and that this may entail both increased risks as well as increased opportunities for investors compared to a passive index fund. Plus, you don't mind the higher expense ratio, which is already deducted from these historical return numbers here. On the other hand, you should probably not consider an investment in CGDV if you agree with even one of these statements. 1. You fear a potential market correction and are looking for a more defensive investment that may potentially stabilize your portfolio in a crisis. CGDV may not be that fund with its current large exposure to tech and its generally not very defensive mandate. 2. You don't like the high concentration of CGDV's portfolio in only about 50 equity positions and would prefer a more diversified fund. Active fund managers with a wide mandate may sometimes be tempted to place a few more concentrated bets versus maintaining a high diversification at all times. 3. You are looking for a dividend fund with a longer track record, for example, one that has already survived the great financial crisis of 2009. Or the thought of owning CGDV would not let you sleep well at night for any other reason. Of course, that's our perspective only, and everyone's financial journey is different. Plus, as we often say, it's rarely all or nothing in money and investing. CGDV or another dividend fund may still play a constructive role in an overall well-diversified portfolio. So I hope you enjoyed part 5 of our Dividend Fund Miniseries. And if at this point you're interested in joining our daily member conversations and regular deep dives into other potentially higher yielding investment opportunities, come on over and check out our VIP investment club. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more and join us today. We've also linked everything below this video for your convenience. And drop a comment below and let our Diamond NestEgg community know. What are you buying right now and what ETFs would you be interested in learning more about? Thanks for watching and I'll be back.